your host, Josh Appleman, founder and CEO of Appleman Properties. We're joined today by Arn Cedella, a highly experienced real estate broker and investor with over 44 years of industry experience. Arn started his career at his family's residential and investment brokerage firm in Menlo Park, California in 1978, where he built a successful career as a broker and investor. In 2020, he founded Spark Investment Group and currently manages over 818 units, worth over $92 million as a general partner and sponsor. Arn's moved to Greenville, South Carolina in 2014. Arn, we're excited to have you here with us today. If you could, let the audience know a little bit more about yourself.
Yeah. Hey, Josh. Great to be here. Thanks for the opportunity to meet with you and your listeners. So I got a master's degree in chemistry, but never did anything with it, and ended up going back to California, to Silicon Valley, and went to work for my dad in his residential brokerage business. Sold real estate there for 35 years, started investing, built up a single family portfolio, made a life transition, moved to Greenville, South Carolina, and we're very happy here. And then about 2020, right about the time COVID hit, I started to transition to multifamily, and that's what I do now. And we can, explore that more as we get into the talk.
Yeah, for sure. And like we were talking earlier before we got on here, it's incredible how you made the transition from single family to multifamily and the amount of units that you've accumulated over the past 3 years. What made you want to get into multifamily? What was that? What was the defining moment?
So I had a couple defining moments. One was a phone call with a young investor friend of mine here in Greenville, who had started syndicating maybe back 2018 and 19. And he said, "Hey, Arn, you should get into multifamily." So he turned me on to a couple podcasts. I started consuming information and education. And so something new was intriguing to me. Also, what I do is I keep track of my personal financial statement, my schedule of real estate owned, and every quarter kind of take a look at that. And also at tax time, when you kind of add everything up. So I'd kind of do a study that would be basically cash return on the equity I had in my single family investments. And while the single family investments did great in terms of increasing in value and so forth, it turned out I was probably only getting about a 2 to 3% return on the equity I had built up in those single family properties. And now at the age of 68, I'm kind of a little bit more interested in cash flow. So it made sense for me to transition that equity to multifamily, start getting 6, 7, 8% cash on cash returns. And then the other part of it is, with multifamily, you get to partner with people who have skills and abilities you do not, or I do not, right? I'm good at a few things that I do, but I'm lacking in other areas or not the best. And so by moving to multifamily, you can put together a team, typically 3 or 4 people who all bring a different skill set, and combined, put in that team, it really kind of forms a rock solid team. So it maximizes my abilities, but allows me to leverage other people's ability for the greater good, for the team, for the investment, and our investors.
Awesome. And that's a very high performing team that you're able to put together too. It's everyone is a pillar to the investment. Awesome. What do you think sets your experience and expertise apart from other real estate brokers and investors in the industry?
Well, just that I'm still here and I'm still doing it. So I've been through several economic cycles. I paid 11.75% on my first home mortgage. So when interest rates go to 6, 6.5, I don't lose my mind. To me, that's normal, right? I've been through Black Monday. I've been through the S&L crisis, the dot-com boom, the dot-com bust, the Great Recession. So I've been through numerous cycles, was fortunate to sell real estate in the Bay Area, but I also invested elsewhere in the country. So I would say my unique value proposition, if you want to say it that way, is just some longevity in the real estate industry with broad-based experience in various areas.
Nice. Yeah, absolutely. Yeah, and you've got knowing the broker side and the investor side. That's a very unique caliber. You get what they're needing and what motivates them, and you're also bringing in your investor side. And it's a balance. If everyone walks away from the table with a win, high-fiving, let's go celebrate. And
yeah, and for me, early on when I went to work for my dad, he said, the brokerage is great to create income, but the key to financial freedom, security, wealth is to invest that income. So I found kind of the brokerage generating the income that then allowed me to put the capital to work in real estate. And that's really where you win the game at the end of the day, is by investing those dollars.
Yeah, I totally agree. It's just kind of knowing where your money's at. If you put $100,000 out there in a piece of property, it's not in your account, but you know exactly where it's at. It's peace of mind as well.
Yes.
How do you select which multifamily properties to invest in, and what factors do you consider?
Well, for me, I'm located in Greenville, South Carolina, which is the northwest part of the state. And so for me, local knowledge is extremely important. So I think if you're going to be a good investor, you need to kind of know the lay of the land in your markets and have kind of a intimate knowledge of what's going on in those communities, what's happening with the market in terms of rent and sale values. And I think also as you get embedded in various markets, you can pick up on what submarkets are going to trend well, and you can see that the path to future growth is there. And I would give the example, like you could look on a map in your market, and this location could be primo A1. You could go a mile away and it could be a whole different type market. Unless you have that local market knowledge, you might not really understand that. So for me, I invest primarily in the upstate area of South Carolina, where I know what's going on. I can go buy my properties on a regular basis. And for me, that's a real key. If I'm going to ask folks to invest money with me, their hard-earned capital, I have to have a high degree of confidence that I know the market and I know that the business plan is practical and able to be enacted. So that confidence about the local market's really important.
Yeah, no, that's huge. That's in knowing the path of progress. You could buy something that might be look distressed on the outside, but they don't know that a huge employment driver's coming into the area, or things on that. Because you're right, it could be street by street in some cases.
Very much so. And neighborhoods where you start seeing flippers move in and they're flipping homes. There might be a little retail strip, and all of a sudden a real hip coffee shop goes in, and then a cool little brew pub or restaurant. If you can kind of get ahead of that curve, that's where you can really make some good investments. The other way I say it is invest in areas before they become front page news. Yeah. Because by the time they're front page news, now you got all sorts of competition.
Yeah, and that's kind of like looking at the hot markets to go in, like basically Texas, Houston. It's unattractive to even look at those areas because that the herd's already there. It's you're buying on a future value that's not there yet, and giving away essentially your equity.
And a lot of competition, and you have to find the right pond to kind of swim in. I've done very well, but of course, there are multifamily operators that knock down $100 million deals every other month. That's not where my business is. It's not where I really want to be. So you have to kind of find your niche where you can compete and that you know the market.
Yeah. Are you focused on primary, secondary, or tertiary markets?
Well, I would say Greenville is probably a tertiary market. It's midway between Charlotte and Atlanta on the I-85 corridor, 90 miles from one, 120 from another. And so I think there's a lot of opportunity in these tertiary markets. You do have population growth coming. And I'd say the other thing, if you can find some of these smaller markets on a major interstate freeway between larger markets, you know the growth is eventually going to follow that interstate corridor or whatever it is. So good logistical location on transportation, but a little bit smaller area. I think that's the most fruitful place to look.
Yeah, totally agree. And there could be some huge winners in tertiary markets as well. Even if you've got hospitals and the proximity and different good.
And the rents are a little bit more affordable, and we also know affordability. So I like to kind of keep my rents. Ideally, I kind of like 11, 12, 13, 1400. That's just a good, solid rent level, hardworking people, good tenants, not the luxury type apartment, but then maybe not some of the issues that you get with much lower income tenancy and so forth. So I think that's kind of a sweet spot, at least for me in the Greenville market. Now, of course, prices are different in different markets, but relatively, that's where I'd like to be.
Yeah, you're still in workforce housing. You're providing it affordable housing, workforce housing, so it's sustainable. It works.
Lots of demand.
Yeah. Are you working side by side with a property management company as an operator and asset manager, or do you have in-house property management?
That's a great question. And effectively, it's in-house. Effectively, you could say we're vertically integrated. Technically, we are not. And let me explain. My primary partner here in Greenville is a guy named Brian Walsh. He owns Progressive Properties of Greenville. We both raise capital. We both look for deals. He handles the operational side, where I probably spend more time bird dogging the deals, dealing with the attorneys and the financing and the investor relations. So we're vertically integrated in that the property manager, Brian, is an integral member of the general partnership. We're equal partners. I have my area of responsibility. He has his, and we each have dominion over our area. And I have found it to be a really good model because Brian has his investors in the deal. He has more commitment to that deal and the operation of the property than your typical property manager. And I'm not being critical. It's just he's part owner of that property. So he really has a vested interest in to get it to perform. So he handles everything from the renovations, the leasing, and the whole bit. So I turn that over to him. That's not what I'm good at, and I'm happy I got a great partner to handle it.
Yeah, and that's definitely vertically integrated. And there is an alignment of interest, 100% based on experience. The expenses are maintained, they're groomed, they're red flagged if they don't look appropriate or look inflated, just by having that level of control in-house and that alignment of interest. We've had you go through experiences in real estate and you learn from them, and having relying on third-party property management to make the best financial decisions for the property that you own is it's not all there.
Yes. And the other thing is there's just that one more layer of communication you have to go through. And it just adds a little bit of delay to getting things done. So we really like the model we've developed, and it works for us. And that's not to criticize third-party property management at all. There are excellent third-party property managers, but I feel having it all in-house works better.
Yep, I totally agree. How do you balance the needs and goals of your investors with your own investment strategies and decisions?
I would say for me, the investors come first. And so, the decisions we make are for the benefit of the property as a whole, and therefore our investors. And the way I look at it is, if we operate this asset professionally, efficiently, effectively, and create value, create good returns for our investors, we will be amply compensated for our efforts. So there's never a conflict in my mind. If we do good for the investors, we're doing good for ourselves. And I would add, to bring the tenants into the picture, you treat the tenants right, you create an environment, a place to live that they like, that makes that property better run, more efficient, less costly. So doing right by your tenants also ends up doing right by your investors.
That's perfect. And everyone reaches their goals together.
Correct.
That's huge. Can you give an example of a particularly challenging investment decision you face in multifamily real estate industry, and how have you navigated it?
Well, right now it's a pretty tough market to find some deals. So that's been frustrating, but you have to maintain discipline. It's fun to buy stuff. It's fun to get in the action, but you also have to be disciplined. And one of the first properties I bought, the broker brought it to me. CoStar report indicated the units were 727 square feet. So we do a walkthrough, and I go to my partner, Brian. There's no way these units are 727 square feet. So I go, hey, next time we come back, bring a tape measure. So I brought a tape measure, measured them, and they were only 610 square feet.
Oh, wow.
So now my brain's exploding. And I kind of got a little perturbed, and I told the broker, hey, look, we're buying 14% less square footage. I want a price reduction. They basically told me go pound sand. And in talking to my partner, Brian, he goes, hey, look, these apartments work. They got a nice floor plan. They're perfect one-bedroom apartments. They work. The rooms are fine. So I had to kind of work through that, where initially it was a very negative feeling. And it wasn't because the broker misled me. Sometimes CoStar's wrong, and you just have to get to know that. So anyway, Brian talked me off the ledge, and it's turned out to be one of our best acquisitions. So that was a learning experience.
Well, and that's a pretty good nugget for beginner investors out there as well, is double check the information that's provided. That's because that does change things all the way down the line as far as even performance, the metrics, the rent per square foot. I mean, that's huge.
Yes.
And that's something that I can say that I have not double checked, is the square footage of the units. So that's definitely something I'm taking away and applying.
And it's kind of old school, but it works.
Well, yeah, and whether it makes a difference or not on the deal, at least you'd have the accurate information on your side when you purchase the property. How do you see the multifamily real estate market evolving in the next few years, and how do you plan to adapt to these changes?
Yeah, another great question. That's the $64 million question everybody's thinking about. I've always been a long-term investor. As smart as I am, quote unquote, as experienced as I am, I don't believe I can really time the market. So I have a long-term investing philosophy. And if you buy good assets, properly leverage them, And right now, I would say 65% LTV is probably a good place to be. Properly leverage them, try to get fixed rate debt, have ample cash reserves, and you can get a good property in a good location. I'm a buyer even today, even though I know possibly the value of that property could be a little bit less than 6 months. See, but I don't care. What I'm looking at is what's the value 5 years from now? What's the value 7 years from now? And I think if investors can kind of take that long-term perspective, use the current market to be able to buy quality assets in maybe a little less competitive environment, still look at the numbers, but have confidence in the American economy, the US economy, housing demand, housing affordability. Anybody who's looked at real estate over the last 40 years realize the long-term trend is up. And as long as you go about it properly with leverage and cash reserves, you're going to win. So that's the approach I would take, even though the next 12 to 18 months may be a little choppy. But I'm not going to sit and miss a good property just because it's going to be a little tenuous the first 6 to 12 months.
Yeah, that's great. And long-term strategy is that you can't bounce in and out on multifamily, at least not like residential single family.
Well, for in 2020, 2019, 2021, people could bounce in and out.
Yeah,
and that's the other thing, I think. The true operators, the true professionals, the people who actually know what they're doing running these assets, they have a competitive advantage today against other less experienced, less qualified operators that maybe have been bailed out the last year or two by the phenomenal market. So, the cream will rise to the top, but you're going to have to actually know what you're doing to make it a good investment in this kind of market.
Yeah, I think that's where the business operators, the guys who know how to manage the expenses and manage teams and lead the path through economic environments will prevail for sure. It's awesome. Yeah. Awesome. It was a true pleasure having you on today. We could probably talk for hours. We're just going on and on. If a listener wants to get a hold of you, just has more questions about Spark Capital, how can they get a hold of you?
Sure. So I'm on Facebook and LinkedIn, either as Arn Cedella or Spark Investment Group. And the website is investwithspark.com. So reach out. As you can tell, Josh and I love talking real estate. So we're always happy to share and learn from people we talk to. So even though of all the decades I've been in the business, I'm still considering learning, and I'm a newbie in multifamily and looking forward to learn more as I go.
Awesome. And we'll have your contact information when we post the podcast out there so that people can have reference as well. And true pleasure talking to you. I'm sure we will talk soon and appreciate your time.
I appreciate you. Thanks, Josh, man.
Yes, sir. Thanks again. Bye.